Hello, welcome to another talk on money, business, and investment. My name is Jose. I'm the founder of the company and brain here at Master Investor. If you're new to our community, ensure to subscribe and turn on the notifications so that you know when we go live or upload a valuable talk that can change our financial life forever. As long as we apply what we are learning, then we can turn the knowledge that we get there from other people to our own knowledge, right? If we just leave it and don't do anything with it, it's just information. So we want to make sure that we're turning other people's knowledge into our knowledge by applying it in our lives. And make sure to check out the links in the description to join our inner circle. We have 3 ebooks and digital courses right now that will help us build our assets column with real assets that we control. It's going to help us understand from A to Z and how to build a successful business online. If you never launched one before, if you've never done business with a company, it's going to teach you everything about entrepreneurship and invest in the basics of the important topic of money. What is money? How wealth is created? And at the end, the more financial literacy we have, the better we are at investing. The more we know about business, the better we are at investing, because investing is business. And today we have a great topic. It's going to be on the 8 financial ratios for a business owner. On our last live stream we did in our podcast, we did how to keep the entrepreneur spirit going, because entrepreneurship comes with its ups and downs in many occasions, right? We can avoid mistakes that are unnecessary to make. That's why it's important to invest in the right mentors, because when we do, then we can get their knowledge, which comes from the wisdom of their mistakes that they made in their journey, right? And the right mentors are those who already done what we want to do, and they have a track record and so forth, right? We have to choose them wisely, because we have 24 hours a day and we can't just give our time to everybody. We need to choose who are we going to listen to regarding money, how are we going to build our assets starting today, and we need to receive passive income. That's how we are going to be able to tap into total freedom. A master investor must receive passive income, okay? And a master investor is a capitalist, is an inside investor. We're close to the deal, we control, we have leverage, and we can control the cash flow even when we recoup the cash flow back, which we invested at the beginning. So if we're using other businesses to acquire more businesses, we will recoup the initial investment back, even if it's our own capital, right? That's the goal, so that we can tap into infinite return on investment. If you have any questions, please let me know in the comment section so that we know that you needing help and we can address that. Okay, let me check to make sure that we are okay. Yeah, perfect. Anyway, so let's just start with today's talk. And if you missed out yesterday, make sure to go on our website. We have a newsletter that is free, and you will get the articles that we're publishing weekly via email. So if you don't have time to comment to a podcast or listen to a live stream, then at least we have time to read before we go to bed. Remember, we gotta go to sleep a little smarter than we were yesterday financially, so that we can improve our cash flow. Today's summary: being knowledgeable about the different financial ratios puts us ahead of a lot of other investors. Financial ratios assist in reaching fact-based judgments about a company's health. Use these 8 crucial financial parameters to get a clear sense of a company's future. And remember, when it comes to money, there are 2 types of mindset, right? The poor and the wealthy mindset. And how do we tap into the wealthy mindset? Well, we have to invest in financial education. And we have to do what we're doing right now, which is coming onto a podcast or live stream that has valuable content regarding money. We are literally authentic. We are the brand of money, business, and investing of the world. Our mission is to elevate the financial well-being of humanity through high-quality financial education. Made simple, we look at opportunities to build passive income and true wealth. The numbers tell the story, and that advice still holds true, whether we are thinking about establishing a business, investing in one, or already own one. Our financial statement serves as a benchmark for success in business, much as our report card does in academic education or professional education. Understanding how to interpret financial statements and make fact-based decisions about a company's viability are essential skills for anyone hoping to succeed in business. There are three types of education that exist: academic, professional, and financial education. Majority of population, 97%, lacks of financial literacy, okay? Because schools don't have financial education. It was taken out back in 1902, 1903 due to John D. Rockefeller establishing the General Educational Board, which it says that all financial education must be removed from schools, and what they're going to be learning at schools is to become an employee or join the army, become a soldier. Those are the two types of individuals that the school board wants from the school system. So we need to get financial education. That's why people sometimes they're uncomfortable talking about money, or they don't understand how important it is, because they have been taught the wrong information regarding money. They have been taught to work only for money as an active employee, exchanging time for money, right? And as we learn here in our community, time is the most precious asset we all have. Our mind, our time, and freedom. Those three things, we do not jeopardize them. We do not sell them, right? We got to protect them at all times. And what we're doing here to build our assets column with real assets is so that we have total freedom. Remember, rich and wealthy are two different things. Rich is someone that has a lot of money but doesn't have freedom. He or she still has to show up to work to make that type of money. Okay, even if it's a lot of money in other people's eyes, they still have to show up. They're not free totally. Now, wealthy is having assets that produce passive income and capital gains income to us even when we're not there, because a real asset makes money to us whenever we're not working, because it's a system of systems. And once we have those assets paying our bills, our living expenses, and leaving us with positive cash flow, then we are wealthy, which comes with freedom. And that's what we're doing here. So focus on building passive income and investing for passive income, right? That's how we're going to get to passive income, by investing for passive income. Two types of income that can come from an investment is passive income and capital gains income. Passive income requires a higher level of financial literacy to obtain, because it's the best out of the two. And capital gains income will come along the way, because not all assets will produce passive income. Some of the asset classes only produce capital gains income. But when we focus on passive income, then obtaining capital gains income will be very easy, okay? There are many levels of sophistication when it comes to reading a financial statement. We should be able to comprehend our cash flow, as well as the relationships between our income, expenses, assets, and obligations or liabilities as a starting point. However, in order to become a knowledgeable business owner and inside investor, we must broaden our knowledge and grasp even more complex financial principles in order to assess the viability of our company or one in which we intend to invest. Our personal financial statement. Ensure to master our personal financial statement by understanding the 8 essential words of a financial statement. We have the income statement, and there we'll find number 1, income, expenses. Number 2, then we have the balance sheet. We have assets. We have the liabilities column. We have then on the outside of the cash flow, of course, right? And then we have the buying power, the credit, and the net, okay? As you can see, if you're watching the live stream, you can see the diagram, which is showing on screens right now. If you're listening to our podcast, make sure you go to our live stream on YouTube, and you'll be able to see, or subscribe to a newsletter, and you will have it via email. Our personal financial statement is composed of 6 important words. Number 1, income. Number 2, expenses. Number 3, assets. Number 4, liabilities. Number 5, cash. And number 6, flow. Then we must understand the net of our personal financial statement to see where we are financially today in regards to our wealth. Then we will find out our buying power and credit leverage. As we can see in the diagram above, we must have to master the relationship between the income statement and balance sheet. Keep in mind that a business or investment financial statement also looks like the one above. Once we master and improve our financial statement, then we can improve a company's financial statement. Go with rule number one of our community here at Master Investor, which is that we work to build passive income and make money multiply through sound investing. We'll be financially free and building true wealth when our financial statements look like this one below. On the screen, we can see the cash flow pattern of the wealthy. We have assets that are paying us on our income column through passive income and capital gains income, and then we are recycling that money. It's going to go up to the liability column, up to the expenses column, and those expenses, we can always turn them into more assets, because at the end of the day, we can turn a liability into an asset. In other words, we have to make investing for passive income a priority and have financial education in our daily training to build wealth. Take a look at the next diagram where it shows that our main expenses are investing in passive income assets and invest in financial education daily. So the wealthy mindset, about 3% of the population, we focus on number one, acquire assets. Number two, those are our expenses. We start with that, right? We pay ourselves first, meaning that we're going to acquire assets first. And then we pay taxes, if any, after, because we're using the power of passive income and capital gains income, which allows us to minimize taxes. And when we use debt, then we can pay zero in taxes, because debt is tax-free. Okay, so when we combine debt with passive income, then we literally can minimize taxes all the way to zero. In many instances, when we use the tax code and follow the corporate law, we need to have a tax strategy. We need to have a team of professionals, okay, tax or CPA, an accountant that knows exactly how to utilize the tax code, okay, that speaks the wealthy language, not someone that has a poor mindset, okay? There are CPAs and there are lawyers that are for the poor mindset. We want to attach ourselves to those people who have the wealthy mindset. And then number three, we acquire liabilities, because we can acquire whatever liability we want because we have assets that will pay for those liabilities. So if we want a new liability, we focus on acquiring an asset first. Wealthy people buy or acquire assets first before tax dollars and pay zero in taxes in many occasions. Then we acquire liabilities by having the assets pay for the expenses of the liabilities. We can obtain everything for free. All is done legally using the tax code and corporate law and to our advantage. Which financial ratios are important? There are important ratios that we may use to assess a company's financial health in order to comprehend its overall health. Key ratios take data from the subject company's financial statements, such as a balance sheet, income statement, and a statement of cash flows, according to Investopedia. These statements' content are compared to one another to create ratios that show important facets of the business's financial picture, including debt utilization, liquidity, profitability, and earning strength. Although calculating these important ratios is not difficult, many individuals are unaware of them. We have already outperformed many investors in our ability to assess a company's health just by reading this article or listening to this podcast. Here are 8 essential financial measures that we should be aware of. Financial ratio number 1. Percentage of gross margin. Calculation: sales divided gross margin equals gross margin percentage. Sales less the cost of goods sold is the gross margin. Therefore, our gross margin is $25 if we sell $100 worth of bananas and they cost us $75. The portion of sales that remain after deducting the cost of the goods sold is known as the gross margin percentage, which is calculated by dividing the gross margin by sales. In this case, the gross margin percentage will be 25 or 25%, or $25 over $100. Why is the percentage of gross margin significant? There won't be a net if the gross isn't there. For example, if we are investing in a company that is losing money despite having a high gross margin percentage, we can investigate whether the company is just being mishandled. Once everything is fixed, cleaning up the operations could result in a very profitable company. How a business is set up and the various expenses it must cover determine how high the gross margin percentage should be. For example, convenience stores still need to pay their clerks, utilities, taxes, rent, and a host or of other expenditures after figuring out their gross margin percentage. They also need to have enough leftover to provide the owner with a healthy return on the investment. It is feasible that we may afford to sell and turn a profit with a smaller gross margin percentage if we run an online business today because there is a less chance of excessive expenses. However, in any organization or company, a larger gross margin is preferable. Financial ratio number 2, percentage of net operating margin. Net operating margin percentage is calculated as follows. EBIT divided by the sales. This ratio indicates the net profitability of a company's activity before deducting costs such as taxes and other uncontrollable expenses from the owner. Sales less all operating expenses, excluding capital costs like as interest, taxes, and dividends, is our earnings before interest and taxes, or EBIT. It offers us an idea of how well a company is being handled and accounts for costs that are under our control. An extremely volatile EBIT may be a sign of a hazardous company. A steady one can be a sign of one that is predictable and well managed. How come net operating margin matters? Net operating margin percentage is the ratio of EBIT or to sales. Generally speaking, companies with higher net operating margin percentages are more robust than those with lower percentages. Better still, the higher. Financial ratio number 3, operating leverage. Operational leverage is calculated as contribution divided by fixed expenses. All businesses need to include fixed costs in their total cost structure. Operating leverage is the ratio of fixed cost to total expenses, which is computed by dividing contribution by fixed cost. Contribution is defined as gross margin, sales less cost of goods sold, less variable cost, all other costs not related to fixed cost that change with sales. Example of fixed costs include labor associated with full-time staff and the majority of facility-related expenses. Most people refer to this as overhead. What makes operating leverage crucial? A company with an operating leverage of 1 is making just enough money to cover its fixed expenses. This will imply that the owners receive no compensation, no cash flow. Any value greater than 1 indicates a profit. Once more, higher is preferable. It can be worthwhile to investigate whether an under-leveraged operating margin exists in a business with low operating leverage. A larger operating leverage could result from raising the gross margin through actions like raising prices or adding other assets and getting new clients. Financial ratio number 4, leverage. Financial leverage is calculated as follows. Total capital used divided by shareholder equity. For most businesses to function, borrowing money is a need, and we should adopt the mindset to acquire as much debt as possible, to learn how to use debt, to learn how to invest debt. So if we have a credit card, we're going to launch a business, we're going to launch a brand, whatever that may be, but we're going to turn that into passive income. We're going to turn that debt into passive income. And that's how we start building assets that we are not even paying for. Other people is paying for that. Other people's money, right? The bank's money. If we're using the bank's money and we're creating money with that money and we're paying the bank back with the revenue of the business, which we created with that money that they allow us to have, and we're paying the interest back, and also it's paying us a positive cash flow because whatever is left over is our positive cash flow, then that debt is good debt. It's making us money. It's making us wealthy, tax-free. One important financial measure that indicates how much a company uses borrowed funds is financial leverage. The accounting value of all interest-bearing debt plus all owners' equity is known as total capital employed. Therefore, our financial leverage will be 2. For example, 100,000 divided by 50,000 if we have 50,000 in debt and 50,000 in shareholder stock. Why is financial leverage significant? Similar to life, we don't want a company to have too much debt, but if it's good debt, then we want it to be as much into good debt as possible, because that means we'll be minimizing taxes. As long as the debt is making us wealthy by paying the debt and its service back, interest and expenses, plus is leaving us positive cash flow every time we make a payment to the bank, then that is good debt. We want to be in that type of debt as much as possible. Okay, there's no limit, because the more we get into that, the more leverage we have and the more buying power we will have. We can acquire bigger assets because the banks will start lending us even more money because they know that we can manage debt. It's very that simple. At the end of the day, when it comes to building wealth, we need to understand how to use debt, how to minimize taxes, using debt, using the tax code, and how to build true brands, not just businesses that can be replaced by somebody else. We need to build true brands, which means that we need to have intrinsic value and business integrity. Okay, intrinsic value means that the business has its legalities in order. So if we need to protect the logo, trademark, we need to protect whatever we're doing that is unique, that no one else can take from us, none of our competitors. So patent, intellectual property, and so forth. Okay, that's how we instill intrinsic value into a company to turn it into a brand. And of course, it needs to have business integrity, like I mentioned, which means that it needs to make a profit. Okay. A company is riskier than the more financial leverage it has, because there's more debt that needs to be paid back. But again, if it's making us money, then it's good debt. Okay, depends on the type of debt that the company has. That being stated, the parameters for what constitutes a sound financial leverage vary depending on the sort of organization. The entire picture of financial health is heavily influenced by other variables, including cash flow and cost of debt. Financial ratio number 5. Total leverage. Calculation: operating leverage times financial leverage equals total leverage. The operating leverage key ratio number 3 and financial leverage key ratio number 4 are multiplied to get the total leverage. As a company's owner, we are insiders, and those have some control over the overall leverage of the company. Why does total leverage matter? The overall amount of risk that a business has in its current operations is represented by total leverage. Total leverage indicates the overall effect on equity owners that a specific business changes should have. Total leverage on the stock market might assist us in determining whether or not to invest in a company. A well-managed American corporation typically maintains a total leverage ratio of less than 5. Financial ratio number 6, debt to equity ratio. Debt to equity ratio calculation: total liabilities divided with total equity. This one should go without saying. It is a measurement of how much of the entire business total liabilities is funded by outsiders compared to how much is funded by insiders total equity. Most companies aim to maintain a ratio of 1 to 1 or less. Why is the ratio of debt to equity significant? In general, a company's financial structure is more conservative the lower its debt to equity ratio. There's less danger in a corporation with more conservative financial structure. We will have to assess our personal level of risk because an investor may not always be searching for less risk. We can determine whether a possible investment is reaching or exceeding that acceptable risk level with the use of this essential ratio. Financial ratio number 7, quick and current ratios. Quick ratio is calculated as liquid assets divided by current liabilities. Current ratio can be calculated as follows: current assets divided by current liabilities. Like I just mentioned, the purpose of the quick and current ratio is to indicate to us whether the company has sufficient liquid assets to cover its liabilities for the upcoming year. A fast ratio solely considers liquid assets. This includes assets like money, securities, and receivables. It does not account for items like inventories, which could take some time to liquidate in the case that obligations need to be paid off, in contrast to the current ratio. Which ratios are appropriate to utilize will depend on the kind of company we are examining. A company that has a history of high inventory turnover, for example, might be better off using a current ratio, whereas a company that transfers its goods slowly will benefit more from a quick ratio. What makes current and fast ratios significant? It is typically an indication of trouble ahead when a company's current obligations exceed its present assets. Conversely, it is more appropriate to have a current ratio and a quick ratio of at least 2-1. Financial ratio number 8, equity return. Net income divided by average shareholder equity is the formula. Many people rank return on equity as one of the most significant essential financial ratios. It lets us evaluate how profitable a business is for its investors in relation to alternative investments. What makes return on equity crucial? Making money is the main goal of both owning and investing in business. It is not worthwhile to invest our time in a business with a low return on equity. Return on equity is influenced by a variety of factors, so it is critical to use all of these statistics to identify potential hiding opportunities in a company. For example, a poorly run company may have many metrics that look terrible, but in the proper hands, they could represent a gold mine. Although the ratios might seem difficult at first, we will be surprised at how fast we can pick up the skills necessary to examine a corporation. Running these ratios on our own after downloading the financial statements of publicly traded corporations is a pleasant activity. See what we can discover and learn how to locate the information we require. Recall that these ratios represent the vocabulary of a sophisticated investor. Through self-financial education and acquiring financial literacy, right, we too may acquire the ability to speak in ratios, and we can apply all of these ratios in our investing plan. That's why it's important that we educate ourselves daily and we actively invest. That's how we do self-financial education, right? We're applying the information, we're getting information, and then we're applying it, right? And we should be able to do that every day. So whatever we're learning today, then let's go ahead and start building our idea into fruition, right? Let's build that first asset. Let's acquire the first asset. Which of the asset classes are we going to invest in starting right now? And if we already have a business, what is going to be our next business, right? We should be able to continue to build wealth because remember, we're acquiring assets that run on themselves. Otherwise, they're not assets if it requires us to be there. Choose the side of the cash flow circle that has freedom to be wealthy. As we can see on the screen, we have the cash flow circle. On the left side, we have the employee, the self-employed. On the right side, we have the business owner and the inside investor. On the right side is where we create wealth and total freedom. On the left side, those people seek security and benefits, but they don't have total freedom. And if they don't work, they don't make money. And when they work and they make money, they pay the highest in taxes. So they don't keep everything that they make. Now, once we have chosen where we want to spend our time, then we must get started by investing in getting new financial education daily. On the right side of the cash flow circle, we focus on building passive income, positive cash flow through businesses and investing. When we master to receive passive income, then automatically we will also get capital gains income from investments. Not all assets and asset classes bring passive income. Some will only bring in capital gains income. Focus on passive income and capital gains income will be easy to obtain. 3 types of income: earned income, capital gains income, passive income. Capital gains income and passive income comes from investing, and then earned income comes from having a job. So 2 types of income comes from investing, and the other one comes from actively exchanging time for money. Eventually, our businesses will buy other businesses, and investments that cash flow positively. When we achieve this, then we have tap into the velocity of cash flow and infinite return on investment, which is money for nothing. The best time to become wealthy is now because of the ability to access information and sell worldwide with systems. Take advantage of our courses. We have 3 right now: the 10 new rules of money, how to build cash flow with the internet, turn passive income on, and how to invest in crypto to build wealth, understanding Bitcoin and blockchain. We can also find them on Amazon and Kindle. However, when we go to our website, you will find additional assets and bonuses that come with each ebook. And we are adding more as we go. When you get in today, you will be grandfathered in for any other asset that we add in there at no additional cost. So it's a great opportunity. It's a win-win. Go to our website, subscribe to our free newsletter, and of course, get the ebooks right now because they will help you get started in our investing career. And of course, it will help us create total freedom and achieve our dreams because we need excess of cash flow in order to get what we want out of life. Money is a very important element. Otherwise, we can't really manifest what we want. We need to have money. We need to have excess of cash flow. And when we make money without working, it's even better because then we are thriving through our purpose in life. We're not doing things because of money. Money's already master in our life. So we're not doing anything. We're not selling our time or we're not compromising. We're actually moving through our passions, okay, which is important. We need to exhibit those passions to the world. Now we have systems that we can monetize them as well. So we can even create income, passive income through our passions as long as we understand the basics of money, business, and investing. Exactly what we're doing here in our community at Master Investor. We're doing a live stream every day. We're bringing you the good and bad news of money, the business principles that work in all economies. If you have any questions about today's talk, let me know in the comment section. I'll come back and answer them. And make sure you go through the entire article again. And if you need to listen to the podcast or the live stream, make sure we do that because we have to master these financial ratios for a business owner in order to tap into the velocity of cash flow and infinite return on investment. That's when we're getting money for nothing. We're using debt, we're making money. If we invest in any of our capital, we got that capital back because the business operation is bringing us excess of cash flow, and then we still collect positive cash flow because we control the asset even after we have no money of ours invested into the deal. Bringing you the good and bad news of money, the business principles that work in all economies. Thank you for listening to another great talk. I'll talk to you on the next one. Stay extraordinary and wealthy. Bye for now. All right. So, perfect. Make sure you click the links in the description. Join our inner circle right now. Okay. Take advantage of the offer and begin working on the assets column. Okay. Focus on that column because that's how we're going to break free from the rat race. It is the only way to create financial freedom. Otherwise, you'll be part of the 97% of population, which only works for earned income. And so they never get to enjoy life because they want to be at the beach, but they're working. Somebody else owns their time. You don't ever want to sell our time to anybody. Never. Okay. We want to, yeah, of course, if we have to do whatever we need to do, but we need to focus on that asset column. So if you have a job, then you need to not quit right away, but build an investment plan that we can take small steps every day and we can build an exit strategy, right? Okay. Make sure you focus on building our network. We have to collect emails and potential buyers and clients every single day because we have sales funnels, right? We show you exactly how to do all of that inside of our ebooks. So make sure you go get them. Okay, let me get this link over here. So it's important that we go out and network. And meet new people, and also through content that we're creating, whatever brand you want to build, make sure that the brand is producing content that is useful for other people, right? And that's how we get new clients and new customers, because we are providing value and they have no other choice but listen to what we have to say, because we have expertise in what we're talking about and we can actually deliver our promises to the customer. It's all about on their promise and over deliver when it comes to building a business focused on customer service, right? Today with AI and technology, it's important that we have the human touch as well with people, because today they still want to have that. So we can do that with systems. Just make sure that we build a culture, that we're building a true brand, and we follow in the 8 financial ratios for a business owner that we talked about in Master today. And if you need to talk to somebody, go out there and talk to them. Don't be afraid. What is the worst that anybody can say no? You'll be surprised how many relationships I have built through going up and introducing myself, okay, and providing value. People recognize that we're authentic. So don't feel afraid of doing something. Attack our fears. We have to. That's how we find greatness and we step outside the comfort zone. We have to be uncomfortable all the time. That's how we stay growing. If we're not growing, then we're slowing down, we're going down. We have to educate ourselves. That's why reading our articles daily or whenever we publish one is important, and also invest in our financial education. Go out there and find other mentors, but choose them wisely and start investing for passive income. Okay. Let me just fix a type or so, and then I will see you next time. Make sure you take action, okay? Okay, actually, I found my first typo here. Mhm. All right. If you have any questions, let me know. I hope that you learned something new about business today that you can implement in your life. Make sure you check out the website with tools and resources that we have available for all of us to build true wealth. Remember, being rich and wealthy are two different things. Rich is someone that has money, a lot of money, but they don't have freedom. They still have to make effort to show up to work to make that money. So they're not totally free. Somebody else owns that time for them to make that money. So what's good to have a lot of money, but we can't really enjoy it? Well, if you love your job and that is what you were born to do, then that's great. There's nothing wrong with that. But I still recommend that we all learn how to invest, regardless whether we love what we're doing now or not. We need to learn how to master money, how to make money our slave, how to turn money into passive income and capital gains income. And it takes financial literacy. So go ahead and invest in financial education today here with us at Master Investor. I appreciate you being here once more, and I'll see you later. Thank you for being a loyal subscriber and keeping Master Investor working. We all have an investor inside of us, and the goal of our community is so that we develop true leaders, wealthy entrepreneurs, and master investors, capitalists, inside investors, right? And we operate with businesses. We control the asset. We have a voice. We have leverage, and we understand the 8 financial ratios for a business owner that we mastered today. Stay extraordinary and wealthy, bringing the good and bad news of money, the business principles are working on